There's a look at what's happening with the broader market today. And in a time of selling within the stock market, you have seen investors seeking some safety in the U.S. dollar. The greenback hit its highest level since November. And we want to get some more perspective on the road ahead for the currency market. Thierry Wizman is global FX and currency strategist with Macquarie, joining us now. Thierry, what would you say about what's been driving the U.S. dollar?
Well, I think it's undoubtedly Fed policy and the rhetoric that has come out of the Fed since the last meeting. I think that the market was somewhat shocked by the fact that the Fed's dots in 2024 and 2025 were raised, and that the Fed followed up with this with rhetoric that calls for rates to stay high for long. What the Fed is seeming to signal is that it is okay with higher yields in the bond market. And I think it wants to signal this because it still sees pockets of strength in the U.S. and a resilience of some sectors in the U.S., especially housing, to higher yields. And I think, first of all, it can afford to allow yields to rise in view of that resilience, but also to the extent that it wants to continue to slow consumer prices. I think the Fed feels as if it needs to tamp down on the housing market and crush a little bit that feeling of wealth that consumers have from high housing prices. If they manage to do that, they will have more success in quelling inflation in the long run. So that's the reason behind high for long. Unfortunately, when you do have higher yields, it tends to reduce multiples on stocks. That's why we're getting the stock market sell off. And that in turn creates this sense that, investors need to flee to quality. And of course, high yields promote flight into the dollar too. So that explains why the currency here in the U.S. is doing well.
We are watching the Bank of Canada navigate similar issues that the U.S. Federal Reserve is dealing with right now. Some might argue the BOC is closer to the end of the rate hike cycle just because of the level of household debt in this country and the housing market exposure to these higher interest rates. Nevertheless, it is interesting to see the Canadian dollar weakness at a time that we have still seen obviously pretty hawkish commentary from the Bank of Canada. Even we mentioned one of the deputy governors in a speech today noting that the fight against inflation has proven quite difficult. We are currently looking, though, at the loonie below 73 cents U.S. So we're basically at our lowest level in about 6 months' time. Does that surprise you?
It doesn't. I think to the extent that investors are starting to appreciate the prospect that the U.S. economy has to slow down in view of what the Fed is trying to accomplish, it stands to reason that by extension, the Canadian economy needs to slow as well, given the interconnectedness between the economies. But more than that, it's very possible that given that, there is a high level of housing debt on the balance sheets of Canadian consumers, that whatever adjustment, the Canadian economy is going to undergo in 2024 is going to be greater, more severe, more significant than the adjustment than the U.S. economy has to go through. And that's why at Macquarie, we do believe that both economies will slow in 2024, that the U.S. will slow because it's a consumer-led slowdown, but the effect in Canada will be even greater. In other words, it will also be a consumer-led slowdown, also be a housing-led slowdown, but a more precipitous one, a more significant one than the one we're going to see in the U.S.
And what is your prediction then on where interest rates end up as we move into 2024?
Well, as we get to the end of 2024, in view of the fact that we're going to have a significant slowdown in both economies, we do expect both central banks to be in easing mode certainly by the time we get to the end of 2024. Conceivably, we can see anywhere from 100 to 200 basis points of loosening or reductions in policy rates in the U.S. But if that's the case, we're inclined to think that we can see even more coming out of the Bank of Canada next year.
Well, we'll watch that very closely. We also tend to track energy and its relationship, for example, to the Canadian dollar here as well. Oil prices, while they've stumbled a bit over the last week, have been red hot. And I do wonder how you measure how connected the currency story ultimately is to the crude story. And the fact that I guess you could say oil is looking somewhat resilient in the face of a stronger U.S. dollars is notable.
Yeah, I mean, from the perspective of how we look at the Canadian dollar, I'd say there are two things that are of utmost importance. The first is the oil price, because it determines Canada's terms of trade to a large extent. And the second one is that spread in yields between the U.S. and Canada. Now, keep in mind that while other currencies like the euro, like sterling, like the yen, had been collapsing against the U.S. dollar in the few weeks preceding this mini drop in the price of oil, the Canadian dollar actually outperformed. And I would attribute that to the fact that, yes, even though it was disadvantaged versus the U.S. dollar because of the yield story, it was also advantaged because of the rise in oil prices. So, yes, we're seeing some weakness in the Canadian dollar today and maybe in yesterday as well. But keep in mind, this comes off of a period of relative strength for the Canadian dollar. It should not obviate the premise here. Higher oil prices are good for the Canadian dollar, but if we should get U.S. yields continue to widen against Canadian yields, that will be bad for the Canadian dollar.
Okay.